Welcome back to the Property Frontline Market Watch series. I'm here again with Scott Hochgesang, and we've also got a special guest, Darryl Mutch from Mutch Financial Services. Hi, Darryl.
G'day,
And
Debra. Errol.
in
G'day,
this
Scott.
episode, we're going to take a look at the latest hooky trend of marketers saying that you can easily build a portfolio of 100 properties in the current market. First, what we'll do is we'll show you the numbers, give you the overall background of the realistic numbers across Australia. And then we'll talk about whether you can really build a portfolio, whether it's feasible, and if it is, what are the pros and cons and how do you do it? Okay, so let me just share my screen and I'm not going to start it again. Okay. Yes. All right. So, Scott, can you take us through the overview of uh, the ownership of property in Australia?
Sure, Deborah. What we're looking at is some data we've sourced from the ATO. It's for the fiscal year 21-22, and it shows us how many properties are owned by a typical investor. So if we look at the pie chart, this isn't on there, but there's about 2.2 million investors that own investment properties in Australia. So big picture, that's the universe of people that we're talking about. And
And
of those, 71% only own one.
yeah,
Um, which is by far the vast majority. And just kind of working our way around this pie chart. Another
can,
19% have two. Yes,
can
Deborah?
I interrupt for 1 second? So you said there was about 2.2 million property investors or investment properties owned. Yeah, around about that.
Yes.
Yeah,
And
out of around about 11 million dwellings. So it's not a huge amount.
no.
Okay.
So if I mean 90% of all property investors own one or two, just big picture. So as we're sort of thinking about the people out there and we start going, sort of further toward owning more, we're getting into a very small number of that universe of investors. So we've got 6% that own three, and then it drops off quite a bit. 2% own four, 1% five. And then for all the people that own six, seven, eight, nine, 10, all the way to 100 or even more, it's 1% of all investors. Um, and there was a chart that was released. This is a Freedom of Information request that was made to the ATO by ABC Broadcasting, and they were able to get this data from the ATO. At the moment, we're taking it as credible and correct, although we did notice it was taken off an article that they initially published it on. This shows the number of actual investors that own 10 or more properties. So 840 of that 2.2 million, 840 own 10, quickly falling off down to 490.11, working all the way down to 37, owning 19, and then 172 investors. This was the big headline, own 20 plus. And if you said how many own 100 plus, it's obviously a much smaller subset of that 172. We don't know how many. It's a very few number of investors. And the only other caveats just to add in here are these are properties owned in their own names, and the ATO is not picking up structures. So, there are properties owned in self-managed super funds and discretionary family trusts and even companies. That's not factored in here. So we've been through the number of properties owned by these investors. Deborah, can you take us into maybe the profitability of these investors and their properties? Who's making money, and who's not? What does the data say?
Okay, thanks, Scott. Yes, so this is a chart from, again, the same source. And what this chart shows is out of all the investment properties owned, those people on average who own one property, this data shows they make around about 1,785 profit per year in this financial year. People who owned 5 was around 10,000. People who owned 10, around 20,000. And then people who owned 15 properties, around 30,000 in profit. But then this chart shows that people who own 20 or more properties, that they are the only cohort not to turn a profit. So this is where, it's like, is the data telling the true story? Each of us have an opinion on this. So, Darryl, would you like to provide insights into what you think is going on with this group where they say they're not turning a profit?
Yeah, look, I'll give you an example. A building quite close to where I live was a commercial building in the past. It was literally a building that was empty for decades. It was owned by a very wealthy old lady, and she did not care about the income side of things. She literally knew that the asset was appreciating in value because it was in a good location. She was just waiting for the day that she would actually develop it herself or get an offer from somebody who would develop it. And that actually happened around 10 years ago. She made a profit of apparently $170 million on the overall deal because she basically had this land bank property. So I think the key factor is once you've actually got so many properties, the key isn't actually paying off a debt because it's probably unencumbered. It's more about, okay, what am I actually making in equity growth year on year?
Yeah. Yeah. Scott, do you have an opinion on what could be happening with this
I
chart?
I would just add to that probably many of these people are getting quite finance challenged and moving toward tier three lending or even worse. And we've all read stories about certain unnamed investors who were paying very high interest rates on their investment properties. We've read stories of people paying 8% when everyone else was paying 3 or 4%. So it is possible that these people have geared themselves up, that obviously speculating for capital growth along the lines of what Darryl was saying, and they're not too worried about the cash flow because they're just trying to buy more and gambling for growth.
Yeah. Yeah. And from my perspective, if this data is correct and it hasn't been tampered with selectively, it does sort of make the case that maybe building a portfolio of 100 properties is not really worth it. Let's take a look at what we do. So at the Property Frontline, we take our clients through this slide where we show our clients how they can achieve their annual continuous income unencumbered. They can achieve it with a certain amount of properties. So if you're looking at trying to build an unencumbered rental income portfolio where you've paid everything off and you're just living on this income, how many properties would you need to achieve it? If it's only 100,000 you're looking to generate, well, what we would say to people is these days you can probably target a property that generates around about 600 or 700 per week in rent, and I've allocated here money for vacancies and also for maintenance and property management. So if you were going along this line, you would only need around about 4 properties. But if you did it the way we help people do it, you would only need 2. And then if you go to the other extreme, so say you want to be able to generate around about 500,000 in rental income, then really at the most, if you're doing it the way we would suggest and target a higher rental return, you would at the most need around about 10, maybe 10 to 14 properties. But again, we would help people, say you wanted 14 properties, you'd only need about 7 or 8 the way we do it. Um, and the reason why we talk to people about this kind of approach is because we know that all of the costs are really prohibitive. Like, why spend all that money on, um, on your legal fees, on purchasing costs, stamp duty, all of that kind of thing? Why not keep the money in your own pocket? And the other thing that's really helping people make more out of what they've got in a smaller portfolio is because we all know that we're in a housing crisis, and so state, federal, and local government are trying to increase the supply of properties. And so this is an example of a New South Wales planning legislation change. But in New South Wales, where once you could only have one property on one block of land for a certain zoning, you can now build 2, 4, or many more. And as I said, this is New South Wales, but every state has something similar to this. And you do it the right way, it's actually not a headache. Um, and so, yeah, these are the types of properties that we've got everywhere in our main cities and suburbs that the government is now saying, like for this one, a client of ours got approval to build 9 townhouses on this block. This one up here, I don't know whether you can see my cursor, but this is a property that had a number of layers of uplift, so they could change the garage so it's a granny flat and could be rented out separately. And then further down the track, they could put a duplex or a manor house on there. And then there's other properties that already have a couple of rental incomes. But Scott, you take that to another level, don't you?
Well, certainly, for people that are really chasing very high cash flow, we might look at just a couple of properties that might have a large number of tenants in them. What you're looking at, you've heard this before in our previous webinars, an example of a rooming house that has 5 tenants in a single property. So you might build one of these in Brisbane, one property, 5 tenants, and get about $100,000 a year of gross rent. We actually have a client who's building 2 of these, and he also has a dual income property as well. And when that portfolio is paid off, that's 3 properties with gross rent of $250,000. So he's not so concerned about having that large number of properties. The focus is on the dollars of income that portfolio produces and having something to live off of. Just a bit of a different perspective.
Yeah. So isn't your philosophy it's the number of tenants, not the number of properties?
If you're looking for cash flow, I think that's one way to think about it. We always like to have a property that has more than one tenant in it because you're paying one set of council rates, one insurance policy. So we're keeping all of our costs down to one, and we're multiplying the number of rents that go against the costs of that property.
Yeah.
Very good way to boost cash flow. Plus, they're new properties, and the depreciation benefits are significant as well.
Yeah. Okay. Is there anything else you'd like to mention on the issue of building portfolios of 100 properties at this point?
I think just generally our clients have mostly started with capital growth assets, buying and building houses, and they've layered in cash flow properties over time. So, it's important to think about your portfolio as a whole, buy the capital growth properties as early as possible, and then ensure you have enough cash flow in that portfolio so that if an unexpected event happens, you lose your job, have a child, and now your working spouse is taking time off work. Many things happen to us in life. The people that are hanging onto their properties in 20 years built portfolios that pretty well paid for themselves. So cash flow is critical, in our opinion, to the success of many investors.
Yep. Okay. All right. Thanks for that. And so, Darryl, so what's your view about this approach? Over to you.
Yeah, look, I just want to reiterate what Scott has said there. You need to start with a plan and you need to start as early as possible. The older you get, the more complicated your life gets at the end of the day. Once your life gets more complicated, more costs and expenses are actually there. Obviously, your income increases, but that actually ties into your borrowing capacity. So borrowing capacity goes up with more income. So building the right base for your portfolio is really, really important. Having that plan is really important as well. I also just wanted to touch on, the key question that a lot of people have is around, interest rates, and that ties into your borrowing capacity. So we definitely have 2024 with no rate cuts, unfortunately. Inflation data is softening, and that is against what everybody else in the world is actually seeing. So our inflation is softening, but not at the same rate as the rest of the world. Um, so what the market has actually recently said, the bond yields are increasing. So what does that mean? It means that our rates are not being seen to be cut anytime soon. So the next cut in interest rates is probably going to be at the earliest May next year. So when the cuts do eventually happen, though, the good news is borrowing capacities will increase. And just to give you one other sort of perspective, during the COVID rates period, where you could get something with a one in front of it, to right now, your borrowing capacity is now at around 60% of what it was back then. So $1 million back in COVID days you could borrow is now at 600,000 right now. And, there are some banks that are more conservative than that even. So
Yeah.
that's my crystal ball.
Okay. And so if people are trying to start to build a portfolio of 100 properties now, we would expect that someone like you would say, well, it would be better to start with an investment property that had good capital growth and good rental return, and then wait until there was equity that they could release and then go again, correct?
Yeah, 100%. And also you need to actually have that plan. So for example, somebody that's buying to build a portfolio needs to structure the first loan the right way as well, so that they can actually go again on that second property opportunity
Yeah.
sooner rather than later.
Okay. And have the banks tightened or softened their approach to factoring in rental returns when you're going for your next, second or third loan? Didn't they tighten it
Yeah,
up?
look, yeah. So the tightening in the rental income, what they actually include, is actually loosened a little bit. So they're actually now including more of that rent, whereas during the COVID period, they were actually a lot harsher on, what rental income they would actually use.
Yeah.
So that is something that is a positive.
Mm.
And if that is flowed through to interest rate cuts, then, it is a good time for investors.
Yeah. Yep. Okay. Alrighty. So in summary then, oh, sorry, what were we going to say?
Sorry, I was just going to add one more thing. It's important that the lenders take all of the rent of a property. You know, for many of these multi-tenant properties that we're working on, I think we do find occasions where the yields are so high, the banks won't accept that. I think we've run into
Yeah.
that on several occasions, Darryl, and often during a build, you know, in particular, you know, you probably are not going to nearly get the credit versus having that completed property fully tenanted with leases and being able to show the bank it actually produces what you told them it was going to produce. And a good mortgage broker is going to help guide you through that, you know, so you're not too optimistic at the start.
Yeah.
Yeah.
It's all about strategy, isn't it?
Yeah.
And which lender to use. That's why I should go to a broker, not a bank. All righty. All right. So just wrapping up then. So 100 properties in a portfolio, is it feasible now and is it worth it? So, as Darryl said, it's possible, but you'd want to start early. Is there anything else you would say about that now, Darryl? Or you said it all?
Yeah, look, at the end of the day, I'm sort of hearing what you're saying here, and do you actually want to do it is the big question mark. So if you can effectively produce your outcome of income with a lot less properties, why do it? That's the biggest question that I've always got to my clients.
Yeah. Yeah, it is interesting because I think for some people it does become like collecting stamps. But Scott, what's your opinion on this whole approach?
Yeah, I think big picture for us, it's to get people to focus on the dollar values and not so much the number of properties. It may sound great to pitch that big number to your buddies out at the pub in, you know, as banter, watching the races. But really, the focus should be on the total value of your portfolio, you know, its equity and how that is growing, the total rents it's producing, and then turning that into a cash flow and watching that grow. So just kind of
Yeah.
encourage investors to get into the dollar values and a little bit off of that number itself.
Yeah. And what always trips me up is people who come to me and say, "Oh, I thought the way that you built a portfolio was you got to buy 10 and then you sell 5 to keep 5." But all that does is put money in everybody else's pocket but yours. It's a real marketing tactic. And so my big warning is be careful who gets the money when you're on that journey. So you have to think about how much money you'll pay in stamp duty, how much money you'll pay in advisors' fees. So whether that's uh, like the legal fees, the accounting fees, and then you've also got to think about maintaining that portfolio, insurance, um, property maintenance, and like the list goes on. And one thing that has always really like got me going is how would you track what's happening with all of those properties? It's probably a topic for another time, but yeah, we've Scott and I have got an opinion about those apps where you put all your portfolio information into that app. Someone else has got your data. But anyway, let's not go there. All right. Well, thank you very much for participating and for listening. Next time on the Property Frontline Market Watch series, Scott and I are going to be talking about not only the latest sales performance data for property in Australia, but whether buying property in super is a really good idea and how do you fund it. Um, if you would like to be notified of when our next episode starts, make sure you subscribe to the channel. And if you would like to speak to any of us, including Darryl, our contact details will be in the summary below. Okay, so now it's time to say goodbye.
Bye.
Thanks, Debra. Thanks, Scott.
Good to see you, Darryl.
Okay.